This is the Economic Club of Florida, a distinguished platform for discussion of the major national issues of the day. On today's program, Ronald Temple from the global financial services firm Lazard on the 1.1 million fewer foreign-born workers in the U.S. labor force this year, even without figuring in deportation.
I think for the Federal Reserve, there's a real challenge. Inflation is still grinding higher as tariffs work their way through to prices. Unemployment has ticked up a little bit, but job growth is much weaker. And if we look at the number of open jobs in the United States per unemployed person, for the first time in years, we're now below 1.0, meaning there are more unemployed people than open jobs. If you go back 4 years ago, we had 2 open jobs for every unemployed person. So that clearly shows signs of slack in the labor market. And one last thing that's very troubling, and if any of you have recent college graduates in your family, you might know it's been very hard to find a job this year. The hiring rate for companies is the lowest it's been since 2013.
Good day and welcome to the 594th in our series of Distinguished Speaker programs. I'm Harvey Bennett for the Economic Club of Florida. Today, we're going to take a look at the bigger picture of the global economy and where the United States fits in. We're delighted to have as our tour guide today, Ronald Temple from the global financial services firm Lazard. Now, here's the president of the Economic Club of Florida, Christopher Emanuel.
It is now my pleasure to introduce Ron Temple. Ron Temple is the chief market strategist for Lazard's financial advisory and asset management business, and he collaborates closely with Lazard's geopolitical advisory group to assess economic and market implications of key geopolitical issues. Previously, he was the senior executive for Lazard's asset management, overseeing U.S. equities, multi-asset investing, and several global equity strategies. Ron has over 30 years of financial services experiences across multiple continents, including the United States, Europe, and Asia. He earned his master's degree in public policy from Harvard University, his Bachelor of Arts in economics and public policy studies, magna cum laude, from Duke University, and he is a member of the Economic Club of New York. We are thrilled to have such a titan of the industry speak to us today. The floor is yours.
Thank you for that introduction, Chris, and thank you for the opportunity to be here today. It's really a pleasure to join you. Over the next 40 minutes, I'm going to try to take you on a bit of a tour of the world. We're going to rapid fire, look at the economies of the United States, the Eurozone, China, Japan, and then talk about what this all means in terms of how markets are responding to the current situation and the outlook. But if I were to start off, I would say we're going to basically talk about 3 primary themes. And number 1 is a convergence of GDP growth across developed economies. What you see on the map, and sorry for those of you on the far side over here on my left, on your right, but basically what you would see if you could see the font is effectively that U.S. growth rates are likely to slow in the years ahead. If we go back in 2023 and 2024, real GDP growth in the United States was 2.8 to 2.9% each year. That's well above what most economists would say is a sustainable growth rate. And as you might imagine, a lot of that growth was coming off the back of COVID. Consumers came out of COVID with a tremendous amount of excess cash on their balance sheets. And as you know, with Americans, when we have extra cash, generally we like to spend it. And so they did that. But in 2025 and 2026, the consensus from economists is that growth rate will slow down to something closer to 1.5%. Now, I'll come back to this in a moment. But historically, economists would say potential or sustainable growth for the U.S. economy is about 1.7 to 2%. I think because of policy changes in the U.S., especially related to immigration, that growth rate will slow materially to something closer to 1 to 1.5%, at least for the next few years. Now, where that's important is the convergence with Europe. If we look at Europe over the last few years, the U.S. has been growing 3 to 4 times as fast as Europe. But this year and next, the expectation is European growth will improve and will be still below U.S. growth, but not much further below. So where the U.S. might grow 1.5%, Europe will grow 1.1 to 1.2%. So that convergence is one theme, and again, we'll touch on that a bit more. The second theme is divergence on inflation rates. And here I think what you're going to see is higher inflation in the United States this year and next because of our trade policies and the tariffs. And very importantly, this is a short-term issue because tariffs, once you raise the price once, the price stays at the new level, and you don't get another increase the next year. So this would be a one-year inflation divergence while you're seeing other economies have inflation slow. And in most cases, inflation is likely to go down faster than those other economies because the U.S. will be buying fewer products from them, less demand for their goods and services lowers their inflation rate and their growth rate on the margin. But that all leads to the third theme, which is a bit more provocative, and I want to be careful to nuance this, but I do think it's the beginning of the end of American exceptionalism in markets. And importantly, I say that in markets part because for the last 15 years, U.S. equity prices have gone up on average 10 to 11% per year. European and Japanese stocks have gone up 2 to 3% per year, and emerging markets have gone up 1 to 2%. So you've crushed the other countries from an economic market performance perspective. And I think the U.S. will continue to outperform non-U.S. countries, but the gap between us is likely to narrow. And we're likely to see improving economic conditions in some of the non-U.S. countries that are finally being forced to reform their economies and try to improve productivity. And in the U.S., we'll have a shorter term period where growth is a bit slower than it has been, and that might actually have an effect on markets, most particularly the U.S. dollar itself. Now, I'll explain all of that as we move through the slides. And again, I just want to be careful. The degree of exceptionalism is what I'm talking about changing, not that the U.S. stops outperforming. So let's go through the U.S. quickly. And the first topic I want to cover is inflation. What you see on this chart are 4 different lines. The bold line is core consumer price index inflation. Now, core inflation is all of the inflation excluding food and energy. Typically, economists like to leave food and energy out because the prices are very volatile and they want to track kind of the sustained inflation rate of the economy. Now, what you'll see is we peaked at 6.6% core CPI about 3 years ago and have come all the way back down to 2.8% year on year from March through May of this year. The last 2 months, we ticked back up to 3.1%. And if you look at the line at the very bottom, that's been the driver of that increase in inflation. That's the price inflation for core goods. So if you think about your own spending, for most people in the United States, the majority of your spending is on services. It's on housing, shelter. It's on doctors. It's on financial services, lawyers, et cetera. About 24% of the core CPI index is physical goods. So these are the things you buy at Walmart or Amazon or Costco. And there you see prices have started to accelerate upward. And that's, again, largely because of the tariffs we've been putting on imported goods, working their way through to higher prices. Now, importantly, for the Federal Reserve, my expectation is the bold line on this chart is going to be close to 4% by the time we get to early 2026. But that will be the peak of the inflation coming from tariffs. And then that number will start to roll back over and decline again as the tariffs work their way through the system. But this is important because for the Federal Reserve, which will be meeting tomorrow and Wednesday and is likely to cut rates on Wednesday, they have a dual mandate. Mandate number 1 is price stability. Mandate number 2 is maximum employment. And for the last 4 years, for the first time, the Federal Reserve has actually prioritized those 2 mandates. The chair of the Fed, Jerome Powell, has said repeatedly that price stability is a precondition for maximum employment. And his point there is if you don't have low, stable inflation, companies are less likely to hire workers. It's more difficult to predict what your capital expenditure should be. It's more difficult for consumers to make big ticket purchases because when you have high variable inflation, mortgage rates tend to be much higher, auto financing rates are higher. Now, if the precondition for maximum employment is price stability, I've just explained that I think inflation will accelerate through early next year. But the conundrum for the Fed is this chart shows you 75 years of U.S. unemployment data. We're at 4.3% unemployment today, which in a long-term historical context is basically full employment. But what's concerned the markets more recently is what we've seen with the growth in non-farm payrolls. What we've seen year to date is 75,000 new jobs created each month. And in the last 4 months, that number is down to 27,000 jobs per month. So it's the slowest job creation we've seen excluding the pandemic, since 2010, when we were basically just coming out of the global financial crisis. Now, what's important here, and this is where we touch briefly on migration patterns. Historically, if you go back about 10 years ago, and I'm purposely going back pre-Biden, pre-Trump 1.0, the U.S. needed about 140,000 jobs per month to keep the unemployment rate constant. You basically needed to create quite a few jobs because you had growth rate of the domestic population, plus you had migrants coming in. And to have stable unemployment, you had to create enough jobs for that population growth. If you go back 2 years ago, under Biden's administration, we had 216,000 jobs per month, but unemployment went up from 3.4% to over 4% because we had over 3 million migrants show up in the United States, many of them not legally, some of them legally, and you needed a much higher break-even rate to keep unemployment constant. This year, and a statistic most people haven't talked about, the number of people in the United States who were born outside of the United States has declined by 1.9 million people without deportations ramping up. So you've seen a significant decline in foreign-born residents and 1.1 million fewer people in the labor force who were born outside of the United States. Now, what's interesting to me about that is, again, deportations have really just started to ramp up after the One Big Beautiful Bill Act was passed, and the Trump administration target is to arrest and deport 3,000 people per day. So that would basically mean 90,000 deportations per month. And if you think back 10 years ago, if you needed 140,000 jobs a month to keep unemployment stable, maybe today that means you need 50,000 jobs per month. Or maybe it's even a bit lower if there are fewer legal migrants moving to the United States. And so the reason I'm going through all of this is I think for the Federal Reserve, there's a real challenge. Inflation is still grinding higher as tariffs work their way through to prices. Unemployment has ticked up a little bit, but job growth is much weaker. And if we look at the number of open jobs in the United States per unemployed person, for the first time in years, we're now below 1.0, meaning there are more unemployed people than open jobs. If you go back 3.5, 4 years ago, we had 2 open jobs for every unemployed person. So that clearly shows signs of slack in the labor market. And one last thing that's very troubling, and if any of you have recent college graduates in your family, you might know it's been very hard to find a job this year. The hiring rate for companies is the lowest it's been since 2013. And so I think what you're going to see over the next year is the Fed will be cutting rates, but it's not a slam dunk. It's not a clear-cut case that the Fed should be hitting the alarm bells about unemployment, because there's a chance that we will see unemployment at or below 4.5% by year end, but inflation looking much more worrisome. And it's going to be very hard for economists in the Fed to disentangle what's going on and what's sustainable and whether they should be cutting rates. Now, I'm going to come back to this because I think central bank independence is absolutely critical for any developed economy to maintain low inflation and low interest rates. And I think this is going to cause increasing friction between the White House and the Federal Reserve. Now, let me go through a few of the key issues related to the Trump administration. And note, by the way, I'm only interested in this presentation in topics that affect the market and economies. There's nothing about social policies. This is not about whether you like or dislike the administration, but I do think there are real economic implications of different policies. And let's start with trade. On January 19th, the weighted average tariff on goods imports into the United States was 2.7%. As of today, the announced, and this is important, announced tariff rate is 17.4%. The actual tariff being charged in the most recent month of data from the Commerce Department in July was 10%. So basically, we've announced an increase from 2.7 to 17.4. We've only actually charged half of that. Now, the simple rule of thumb related to tariffs is that every 1 percentage point increase in tariffs translates to about 0.1% of additional inflation. So far, we really haven't seen this show up in the inflation data. And so when I mentioned earlier that I think inflation will get up to 4% and peak, there are real question marks around that. So far, what we've seen is the companies involved in importing products seem to be bearing the brunt of the tariffs. They don't want to raise prices and lose customers, so they're trying to absorb the tariffs to the extent they can. And in some cases, the companies exporting the products from overseas to the United States are taking the brunt of the tariff. I can give you one real-life example. For Japanese automakers, initially they ate all of the tariffs. They basically paid the whole bill. But if you think about it, if you're the CEO of Toyota and the U.S. announces a 25% tariff, which is what we initially announced, you don't immediately raise prices to cover that tariff. You want to wait and see, what are the Koreans going to pay? What are the Europeans going to pay? What does steel and aluminum costs do to American manufacturers? And by the way, given that American cars typically are part American, part Canadian, part Mexican, you want to see what happens with USMCA in terms of tariffs on crossing those borders. So you wait. And by the way, in this case, if you were the CEO of Toyota, you waited and the tariff went from 25% down to 15%. So you're glad you didn't raise prices and alienate your customers. But now you have this multi-month process of trying to figure out, how much can I raise prices to protect my profit margins, and how many customers do I lose by raising those prices and lose market share? And so I think this whole tariff inflation story is going to take months to show up in the data. And investors, in my view, are getting ahead of themselves saying, phew, there's no impact whatsoever, when it just hasn't shown up yet. Now, the other big topic on tariffs, by the way, is the Court of International Trade and subsequently a U.S. Court of Appeals have ruled that using the International Emergency Economic Powers Act, it's a mouthful, it's IEPA is the shorthand, is not a legal justification for tariffs. Now, very importantly, the president has used IEPA to impose tariffs related to fentanyl trafficking, illegal immigration, and the reciprocal tariffs. So that is about half of the tariffs that have been announced. The other tariffs on autos and auto parts, steel and aluminum, were not under IEPA. They were under Section 232, which is a national security justification. The court ruling does not affect any of those national security tariffs. But recently, basically, the second court ruled you cannot use IEPA to impose tariffs. It's going to go to the Supreme Court. The Supreme Court has agreed to an expedited hearing. But an expedited hearing doesn't mean we're going to get an answer very soon. It could take until early to mid-2026. The reason this is important is it is possible that all of the tariffs we've collected so far will have to be paid back. Now, by the way, I don't know how we operationally collect all of these tariffs. It's already an incredibly difficult process to charge a tariff on every product coming into the United States. If you've actually got to give that money back, I'm glad it's not my job. But bottom line, it's not a catastrophe if you have to give it back. So far, we've collected about $175 billion of revenue. But our view from our geopolitical advisory team is, even if the Supreme Court says you can't use IEPA, and again, sorry you can't read the font, we can share this afterwards if anyone wants the slides, there are 4 other legal codes that the president can use to impose tariffs. We think the tariffs will end up being in place. And by the way, I would tell you, if the next president is a Democrat, I think the vast majority of these tariffs will stay in place, because the Congressional Budget Office forecast is we're going to raise $300 billion a year of revenue from these tariffs. And if you're a Democrat running against J.D. Vance in 2028, are you really going to campaign on saying, I'm going to get rid of tariffs and raise your personal tax rates? The reality is Americans are paying the bulk of these tariffs, but it's a different tax. And so I think they're likely to stay. Now, on to immigration. And I want to be very clear here on immigration. I think every country has to control its borders. It's absolutely critical to national security. And I do think that, again, I don't want to get into like whether you think it's moral or ethical to do what we're doing with immigration. But it is very important that for any economy in the world, your economic growth rate is a 2-factor equation. It's what is your working age population growth, and how productive are those workers? So how many people are working, and are they productive? And if you have more workers, your economy's bigger. And if they're more productive, your economy's bigger. The Peterson Institute for International Economics, which is a nonpartisan think tank in DC, did an analysis of if the U.S. were to deport 1.3 million people in a year, what would it do to GDP and what would it do to inflation? So on the left, you see their analysis. And by the way, why did they choose 1.3 million? President Trump in his campaign said he would have the biggest deportation in American history. President Eisenhower in 1954 deported 1.3 million people. So they basically said, let's just use that as our benchmark. So what you get with 1.3 million people is that's 0.7% of the workers in the United States. So in theory, you would say, well, that's going to shrink GDP 0.7%. It's a little less than that. So on the left, you can see the Peterson Institute said over 3 years, GDP ends up being about 1.25% lower than it would have been without the deportations. And what they've assumed is many of the undocumented workers in the United States are in lower productivity jobs. They might be in agriculture picking crops. They might be the cleaner at the local motel. You can range of jobs. By the way, you find a lot of immigrants in agriculture. 42% of our hired crop workers are estimated to be illegal workers. In construction, 14%. I think the 14% is probably far too low of an estimate. The University of Michigan published a report last year estimating that 40% of Texas construction workers and 40% of New York City construction workers are not legally working in the United States. And what's interesting is where you find the most undocumented workers tends to be any industry where you have contractors and subcontractors. Imagine you decide to build a new house, you hire the local contractor, he hires the subcontractor for the electrical work. Everyone can say it's your job to check the immigration status, but the reality is you're kind of hoping no one does because the workers are cheaper if they're not here legally. You don't have to pay health benefits. You get away with a lot of things. They're not union. And so what you tend to find is high representation anywhere like agriculture or construction, or even basically we have here below that hospitality, anything that involves temporary workers. Again, the ultimate employer might assume the temp agency's doing that job, but they're not. Now, I raise all of this to say, I think at least for the next 3 years, but I would argue beyond that, you're going to have lower population growth because we're going to have much tighter immigration enforcement. It does not change the GDP per capita. It changes the overall size of the economy, but a per person basis, you could argue it might even raise the GDP per capita marginally if you have lower productivity people leaving. But what's important if you run a business, even if you do not employ undocumented workers, if all of your peers do, and you've now got to compete for fewer people, you're going to pay more for those workers. And I think, again, this hasn't had time to work its way through the system. The last topic before we get to the Fed is budget deficits. Couple of updates. This chart shows you in dark blue the federal budget forecast as of January from the Congressional Budget Office. And the CBO, by the way, is a nonpartisan group. It's about 120 PhD economists. They forecast in January that the U.S. would have $21.7 trillion of deficits over the next decade. And again, this is pre-inauguration day forecast, nothing to do with the current administration. The light blue bars show you their estimate of what would happen to the deficit because of the One Big Beautiful Bill Act. And in total, they estimated it would add about $3.5 trillion to those deficits. What we've learned subsequently, but we don't have the calendar year breakdown of, is that the CBO has forecast that tariffs will raise $3.3 trillion of revenue over the next decade. And because you have that extra revenue, deficits are smaller, so you pay less interest on the debt. So ultimately, you get $4 trillion of benefits. So effectively, you end up with tariffs paying for OBB. So one other delta, though, is the Congressional Budget Office assumed growth of 1.8 to 2% a year. If I'm right about migration changing, you might end up with lower growth, lower tax receipts. Bottom line is, I think for the next decade, you're going to have deficits of at least 6% of GDP every year, which continues to be an unprecedented level in peacetime without a national emergency. So again, an increasingly worrisome problem in terms of levels of debt for our U.S. government. And that gets to my last topic on the U.S., which is around central bank independence. And I want to be very clear here that central bank independence is not an on-off switch. It's on a continuum or a dial. And around the world, there is no central bank anywhere in the world that is completely independent of politics. Every central bank in the world has some degree of political involvement. They all have their authorization from a political body. But I do think in a world where you're running very large deficits, where the U.S. has $37 trillion of Treasury debt outstanding and is adding $2 trillion to that every year, it's very important that global investors, not just American investors, but global investors absolutely believe that the central bank is focused on keeping inflation low. And why do I say that last part? Well, the easiest way for a government to make their deficit become less of an issue is to create a lot of inflation. Because if you have $37 trillion of debt outstanding and it's not linked to inflation, if you can get inflation to 10%, it's worth a lot less the next year. It's easier to pay back. In the United States, by the way, $8.7 trillion of our treasuries are owned by foreigners. A lot more is owned of equities and corporate bonds. So if foreign investors start to believe the Fed is going to let inflation rise because the politics basically or politicians want them to let inflation rise, that's really troublesome. And here I would just say, we'll keep it short. We can talk about it in Q&A if you'd like. The situation around Lisa Cook is very important because if the president is able to fire Lisa Cook and replace her, That does give him a lot of authority in February to potentially invalidate the roles of all of the regional Federal Reserve Bank presidents. This happens once every 5 years in February. That happens February of 2026. For global investors, I do believe if you saw Lisa Cook fired, and if that February 2026 motion is made to dismiss regional Fed presidents who are not dovish on monetary policy, who don't want to cut rates, you could see a pretty significantly negative bond market reaction and even more so US dollar reaction. So that's the US. Let's go to the Eurozone. Now, again, the US is the strongest economy in the world. We have the most innovative economy. We have a lead over everyone else in the world on artificial intelligence. But I do see signs of Europe finally breaking free of some of its paralysis. And by the way, I have not been positive on Europe economically in my 35 years in financial services. It's always seemed like a very nice museum that sells good handbags and wine and cheese. But effectively, when you think of tech innovation, you don't think of Europe, right? But what I think is interesting about Europe is there are some positive signs. They're just cyclical, temporary positives. But the most important one I want to save to the end is I think Europe might be at a watershed moment. And this is probably the most positive aspect of the Trump presidency, is that he has forced Europe to start paying for some of their own defense. And I'm going to come back to that at the end, but let's first go through the near-term issues. Unemployment in Europe is the lowest it's been since 1999 when the euro was created. Consumer confidence, this is always a wet blanket on optimism around Europe. Notice the y-axis, the vertical axis. Now, European consumer confidence is a diffusion index. So what that means is you basically survey people and say, how many of you are positive minus how many of you are negative? And there are 4 different questions on current conditions, the outlook, et cetera. And then the net number tells you, are they positive or negative? In 40 years, there has not been a single month where European consumer confidence was positive. 40 years, okay? So effectively, you look at this, it was starting to get better, and then in November, it turned lower after the US election because people were worried about a trade war. But I think you're going to see this start to improve over the next year, in part because energy prices have come back down a lot. After Russia invaded Ukraine, natural gas prices went up 1,000% in Europe. You might remember a few years ago, we were wondering if they would be able to heat their houses in the wintertime because they didn't have enough nat gas. They've largely weaned themselves from Russia, but not enough. And again, I agree with the president here. Europe really needs to cut off buying Russian energy. If you want to quit funding the war in Ukraine, stop buying the energy. Now, where we're seeing the impact of those lower energy prices is on this chart. The blue line shows you total industrial production in Germany. The gold line is energy-intensive industrial production. That gold line is really important. We were down 20% from the Russian invasion to the trough. We're now down about 14%. Now, the challenge for Germany is even with the return of oil energy prices to lower levels, they're still incredibly uncompetitive with US energy prices. So if you're running a chemical company in Germany and competing with a US chemical company, it's not a fair fight because US chemical companies are paying literally 75 to 80% less for energy. So Germany still has a strategic hurdle there. But the other challenge has been their biggest client is China, which we'll come to next, where the economy has been in the doldrums, and increasingly where China's gone from customer to competitor when it comes to automobiles. Now, the good news is manufacturing, purchasing manager index data, turning positive. Anything over 50 says the economy's growing. You can see I gave you the Eurozone and the 4 key economies, France, Germany, Italy, Spain on this chart, all basically at or above that 50. In the services sector, all at or above 50. But what I really want to focus on last cyclical thing is the ECB has cut rates. The European Central Bank has cut rates 200 basis points so far in the last year and a half. In Europe, when the central bank raises or lowers rates, it has a more immediate and magnified effect on the economy. Because in Europe, the vast majority of people have floating rate mortgages. In the US, 90% of our mortgages are fixed rate, largely 30-year. Rates go up, doesn't matter. I locked in for 30 years, right? What it does matter to in the United States is you're not willing to sell your house when mortgage rates go from 3 to 6% because you don't want to replace your 3% mortgage with a much higher rate. In Europe, the rate changes every month for some people. And so what you're seeing on the left is those mortgage rates have come back down materially, which means consumers have more money left over to spend on discretionary items. And on the right, we also see in Europe a lot more of the corporate debt is floating rate because in Europe, 70% of corporate borrowing is from banks. In the US, 75% of borrowing is in the bond market, where it's largely at fixed rates. So in Europe, when you lower rates at the ECB, it has a more immediate effect on the economy. And you finally see on this chart, loan growth was at zero. It's starting to pick back up because people are willing to borrow money when rates are lower. But the real watershed moment is really around Germany. In February, Germany had elections. The new administration basically agreed to change all the rules on the deficit. So the new rule is that any defense spending over 1% of GDP does not count against the deficit rules. Because Germany realized with the new administration in the United States, they were going to have to ramp up their spending. They had just gotten to 2% of GDP. They're pledging now to go to 5%. They've also pledged basically 500 billion euros for infrastructure investment over the next 12 years. And they're allowing their state governments, the Landen, to basically start running deficits for the first time. You put all of this together, there's going to be an additional 115 to 150 billion euros of spending each year from the German government. Now, normally I don't get excited about more government spending because it means bigger deficits. But in Germany, their debt to GDP is about 60 to 65%. In the United States, we're at 100%. So Germany has a lot more room to borrow money to fund infrastructure investments. And even with all this extra spending, by 2030, they'll still be under 75% debt to GDP. That'll be the lowest debt ratio of any major rich country. But where I get excited about this is if you step back, when I said earlier, when you think about tech companies, you don't think about Europe. Part of the reason the US tech industry is so much bigger and more successful than any other country in the world is our Pentagon spending. If you look back for the last 60 years, and go back to the founding of Hewlett-Packard, all these kind of Silicon Valley, a lot of that funding came from the Pentagon. The Pentagon wanted to make sure we had weapons superiority. We have DARPA, the Defense Advanced Research Projects Agency. Europe doesn't have that. And so what I think is maybe being underestimated in Europe is if Europe truly develops indigenous or local military industrial capabilities, and they genuinely try to do this without buying all of their equipment from the United States, they're going to have to fund a lot of tech innovation. And that's going to end up being a benefit to their broader economy, because instead of your brightest young people leaving to go to the United States to go to college and never coming back, they stay in Europe. The educational institutions in Europe are on par with the United States. The intellectual capability of the people in Europe is on par with the United States. They've historically just left because the opportunities were better here. And by the way, what we've seen interestingly this year is new student visas down 28.5% to the United States. A lot of students don't want to come to the United States now. Europe looks pretty attractive. So I do think this is a 10-year story. It's not a 2-year story. You don't create the military-industrial complex of the United States even in 10 years. I'm just thinking you got to start. Markets are all about the direction of travel. In Europe, I think we might have finally jolted them out of their paralysis. Let's go to China, a little less optimistic, and this is not schadenfreude, hopefully, in terms of being happy about someone else's problems. But China is basically in year 5 of a housing crisis. This chart shows you Chinese consumer confidence. And by the way, that massive decline you see is whenever they had the zero COVID lockdowns. And lest we forget, they were literally locking people in their buildings. And you might recall there was one fire where dozens of people died because they were locked in the building and couldn't get out. I mean, that was the collapse in confidence. When they ended zero COVID lockdowns, you had a little blip up for 2 months, and then it rolled right back over. And the real problem in China is entirely made in China. It is not the US trade war. This chart shows you the prices for previously occupied homes in China. In Tier 1 cities, again, the table on the upper right, which is hard for most of you to see, in Tier 1 cities, prices are down 26% from their peak, Tier 2 down 31%, Tier 3 down 36%. The median household in China has 60% of their assets in their house. So it is no surprise consumer confidence is at record lows when you've just lost 25 to 35% of the value of 60% of your balance sheet. And the problem in China, by the way, that's previously occupied housing. And unfortunately, this data series that I really like no longer is being published since March. It tends to happen in China sometimes. When the data is not good, it just stops coming out. You might recall youth unemployment rate that stopped being published a couple years ago, was revised and suddenly was lower. This is the one data series that does still come out. It's the 70 City Home Price Index. This is the price for new homes. The important thing to know, the reason I don't like this index, is this is an index that captures the listing price for the house, not the transaction price. So it also doesn't capture discounting. If you buy a condo in Beijing and they throw in a free parking spot, that's a discount. It doesn't show up in this index. So bottom line, China has a housing crisis. If you look at the data that came out overnight, they have 26 months of supply of housing inventory for sale. Most residential real estate analysts would say 6 to 12 months is a healthy level. You basically have a real problem that's not going to get solved anytime soon. And unfortunately, the government has not been aggressive enough. What they've tried to do is lower interest rates, lower down payment requirements. But again, think of yourself. If you're a typical consumer and you just lost a boatload of money on your house, you're not looking to go buy another one. You're trying to rebuild your assets. And so what I think China needs to do is offer some major fiscal stimulus packages to get spending up, but they also need to radically reform their social safety net. And the longer they wait to do that, the more dangerous deflation is. We've now had 35 consecutive months of producer prices going down year on year. We've had 31 months of consumer prices up 1% or less. The risk is, if you think back to Japan, and I'm going to show you a chart in a moment, Japan had 24 years of no inflation, and the economy stagnated through all of that. The longer this lasts, the more likely it is China faces a Japan-like scenario. And by the way, one more thing, adding insult to injury, is foreign companies are pulling money out of China. This chart shows you foreign direct investment into China. For the 20 years that ended in 2021, 100% of FDI into emerging markets went to China. In 3 of the last 8 quarters, that's been negative. Companies have been taking money out. And by the way, one more detail of this chart, the State Administration of Foreign Exchange that produces this data in China includes all of the profit generated in China by operations of foreign companies as foreign direct investment. So there are thousands of Starbucks stores in China. Apple makes a lot of money in China. Louis Vuitton makes a lot of money in China. They count all of that as foreign direct investment. And even with that, you have 3 out of 8 quarters that are negative. This is a pretty negative sign for where companies are going. And I would argue, by the way, this is a positive sign for all the other emerging markets, because if you're pulling your supply chain out of China, you're not moving it back to the United States where workers cost 6 times as much as Chinese workers. You're going to go to India, or you're going to go to Mexico or Indonesia or some other country that has cheap workers. And so last country, and then we'll wrap up in the next 10 minutes. Japan is a very different story. Japan is a unique animal. This is not a story I'm excited about because it's going to grow. Japan is still a dying country. The demographics are awful. The population has been shrinking for years and getting older. And basically, as for the last 15 years, every visit I go to Japan, the answer is partly robots are going to solve the problem. But even there, it's hard because Japan's topography doesn't allow for big factories with flat floors to have the kind of robots you can put in an Amazon warehouse here. But what's exciting to me is Japan is finally awakening to the importance of shareholders and raising the returns on capital from companies. And for stock investors, historically, when returns on capital go up, stocks go up. Now, let me quickly go through 3 parts of this thesis. Number 1 is deflation is dead. This chart shows you a quarterly survey the Bank of Japan does called the Tankan survey, where companies basically cite whether there's excess labor or insufficient labor. We're at the tightest labor market since 1991. If we look at inflation, this is the Japanese Consumer Price Index. I think it's one of the most incredible charts I've ever seen. For 24 years, from 1997 to the end of 2021, prices in Japan went up 1% in total in 24 years. Since the end of 2021, prices are up 12%. So if you got used to going to the store and prices never went up, you've been in for a real shock in the last 3.5 years because prices are up 12%. And you're basically realizing, wait a minute, if I wait, it won't get cheaper. It's going to get more expensive. It changes your whole psychology as a consumer. And as a company, it changes your psychology around investing in productivity and automation because you're going to have workers demanding higher wages where they used to be okay with no wage increase at all. Part 2 of the thesis is corporate governance. And I never thought I would say corporate governance and exciting in the same paragraph, but it is exciting because if you look, 13 years ago, Prime Minister Abe announced that he was going to change the rules around corporate governance to make companies run more for their shareholders. But it's only been the last 3 years that it's really started to take root. And it took root because the Tokyo Stock Exchange, which is owned by JPX Group, which is a publicly owned company, basically started changing the rules every year and raising the hurdles for being listed on the stock exchange. Now, why would they do that? Well, they realize if their companies become more profitable, more money is going to come into Japan from outside of Japan. And the more money coming into Japan trading these stocks, the more money the Tokyo Stock Exchange makes. So they want to get their governance up to world-class levels. So they started by requiring companies to develop capital action plans if their share prices were too low for too long. This year, they demanded that all prime-listed companies had to report their financials simultaneously in English and Japanese. Only half of the companies did that before this year. So again, would I ever invest in a company that doesn't report in English until 3 days later? No, because by then all the Japanese people have sold their stock and I'm getting the worst price, right? So you need that common ground or a level playing field. The other thing, though, that's happened that's very important is they've changed the corporate takeover code. 10 years ago in Japan, if you were the CEO of a company and you received an unsolicited bid, or in the US we would say a hostile bid, if you didn't want to sell, you could just throw it in the trash and pretend it never came in. That was never allowed in the United States or Europe, basically, but that is not allowed anymore in Japan. In Japan, if you receive an unsolicited bid today, you are required to form a board committee to evaluate the bid. You have to tell your shareholders you got a bid, and you have to evaluate what's in the best interest of the people who own the company, not what's in the best interest of the CEO who wants to keep his job for the next 30 years. Now, that to me is very important because it means if you find a company that's poorly managed, you can basically go in and say, we're going to buy it and raise the productivity and then resell it later on, which is what private equity does all the time in the United States, and it makes for a more vibrant economy. And that leads to the last part of the thesis. Right now in Japan, 51%, the dark blue bar, for those of you who can't see the data, 51% of household financial assets in Japan are in bank deposits and cash. Now, if prices have gone up 12% in the last 3.5 years, you've just lost a lot of your wealth because inflation has made that worth less. Only 19% is in equities and other investment trusts. If you go back 3 years ago, those numbers were 55 and 14. So you're now seeing Japanese people moving money out of cash into government bonds, into corporate bonds, into equities, and I think that could lift the Japanese equity market over the years to come. So where does this leave us all in markets? I'm going to try to wrap up quickly. Back to the very beginning of the story. The U.S., we have this really conflicting, confusing data around inflation and tariffs, unemployment relative to basically immigration policy, a lot of uncertainty. The markets are interpreting that to say the Federal Reserve needs to cut rates and is saying the Fed will cut rates 3 times by the end of this year. And probably more importantly than what happens in the next few months is the markets are saying the Fed will cut rates 6 times, and the Fed funds rate will be between basically 2.75 to 3% by the end of next year. Now, personally, I disagree with that. I think the Fed is not going to cut rates as much because they're going to be worried about inflation. They're going to see that break-even rate come down. But bottom line, short-term interest rates are likely to come down. But the market is also saying inflation is likely to stay high. The market is pricing over the next 5 years that inflation stays at around 2.5%, not the 2% Federal Reserve target. But again, keep in mind the next year the market's saying 3%, so a bit of a fade there. And we can debate, by the way, longer term what AI might mean to inflation. There are other factors that come into play, but near term, I think you should expect more, not less inflation. Interestingly, the markets, and I agree with this, are saying recession risk is low. This chart just shows you the cost of buying insurance against defaults by corporate bond issuers in the high grade or investment grade market. Key point, the 2 horizontal lines show the median and average since 2010 were well below those levels. So the market is saying low probability of default, which basically means low probability of recession. Same in the high yield market. Markets are saying the European Central Bank is done cutting rates. I think we get 1 or 2 more rate cuts from the ECB because inflation is likely to be lower than their target level over the next year. That could add another boost to European growth. And then last but not least, on Japan, the markets are saying you'll get a rate hike from the Bank of Japan because of inflation being at the levels it is near 3%, and that they might want to slow down demand. I disagree. I think the Bank of Japan, after 24 years of no inflation, is going to wait even longer to start hiking rates. Last couple slides. Bond yields, if we look here about what you're getting paid to invest in 10-year Treasury bonds in the U.S. at 4%, I think that's a bit low. Even with a rate cut this week, you can still earn 4% on cash. So if you're buying a 10-year bond, you need to be paid to take the risk that inflation is higher. I tend to think it's kind of unattractive now and think long rates will go higher from here. That matters a lot because if you cut short-term rates and the 10-year yield goes up, mortgage rates are going up, not down. Mortgages in the U.S. are tied to the 10-year, not to Fed funds rates. So just be careful of that if you're expecting a housing boom on the back of a couple Fed rate cuts. Equity markets have been a real shocker this year. If you told me on January 1st that we would have a trade war, that Russia would still be fighting in Ukraine, that the U.S. and Israel would bomb nuclear reactors in Iran, that we would have all kinds of other policy variability, and that growth expectations would go down and inflation expectations would go up, I probably would have said, well, I think equities are going to go down, but they've all gone up. And what you've seen, by the way, is the U.S. has been the second worst performer of the equity markets. The worst market is the French market, partly because of what's going on in France right now around the government having fallen yet again and deficit issues. The best performing market has been the Korean market, where investors are betting that Korea might be the next Japan in terms of changing corporate governance and improving returns. And the second best market has been the Hong Kong market, because China has opened the flow of funds into Hong Kong. So when I talked at the very beginning about the end of U.S. exceptionalism in equity markets, I was thinking of this more than saying something's gone horribly wrong in the U.S. It's that if you're thinking about where to put your money, after 15 years of the U.S. absolutely crushing other markets, maybe this is the beginning of something really interesting. And you can see that most vividly on this chart. On the left, I've shown you the valuation of U.S. equity indices in terms of the price divided by the earnings over the next 12 months. Compared to non-U.S. markets, the S&P 500, the most common benchmark in the U.S., trading at 22.5 times earnings. Historically, that's about the top 5% of valuations we've seen in the last 30 years. We could debate if that's the right way to think about this. But you compare it to any other market outside the U.S., they're all cheaper. And if I look at Europe, you're talking about 8 multiples cheaper, Japan about 7 multiples cheaper, EM 9 multiples cheaper for emerging markets. So I do think for investors there are opportunities outside the U.S. where things might start improving while growth is slowing a bit in the U.S. And so maybe I'll wrap up here and ask if there are any questions. But bottom line, from an economic perspective, convergence on GDP growth rates across developed economies, that could be more structural than cyclical, depending on how the U.S. handles immigration in the years ahead and whether immigrants want to come here like they used to. Number 2, divergence on inflation, short-term issue. And number 3, maybe opportunities for investors in non-U.S. markets. But I do think real question marks around central bank independence that could really affect the value of the U.S. dollar. And for U.S. investors, maybe there's an opportunity of non-owning assets outside the U.S. to benefit in case the dollar does depreciate in value. With that, happy to take any questions you might have in the remaining minutes of the session.
Thank you so much for your expansive view of the world economy. It's been really great to learn a lot today. I have 2 questions. Number 1, I was a little bit puzzled by the Peterson Institute numbers on deportation. I'm wondering, do you know if that includes voluntary and involuntary?
Yeah, so I think the way they did it is they looked at it. Well, first of all, there's a lot of detail behind that chart. In any given year under Obama, Trump, Biden, we've deported something on the order of 300,000 to 600,000 people a year. So what they were looking at was above and beyond those deportations. I don't believe they included any voluntary numbers. So that 1.9 million decrease in foreign-born residents and 1.1 million decrease in foreign-born workers is not contemplated in that chart.
Okay. So that then suggests to me that that's really a worst-case scenario that the Peterson Institute was suggesting, because we're probably not going to hit 1.3 million deportations, but isn't the second side of the employment growth question the fact that we're not reproducing enough in America to begin with to even sustain our population, sort of what's happening in Japan? My second question is about China. And I just wonder how much credibility you put in the data that we actually get from China. And the second part of that is, can't China, because of the way that they control the economy, spin their way out of that?
So first of all, on the veracity of the data from China, real question marks on GDP in particular. We work very closely with a company called Rhodium Group. They help advise our geopolitical advisory team on China macro. Their view is that the 2023 GDP growth in China was probably closer to 2%, not the 5% China reported. And the way they got there is, if you look, housing basically absolutely hit the skids that year. And depending on how you define it, housing as a percentage of the economy in China was as much as 30% of all economic activity. I mean, the low end was 15%, which is just the construction itself. At the high end, you had all the bankers involved in mortgages. You had the real estate brokers, the furnishings, the appliances, right? You kind of fully build it in. It was a huge part of the economy, and it shrank over 10%, and yet GDP didn't slow down much at all. So there are questions around that. And by the way, if you're going to basically mislead with the GDP data, you should probably make sure all the other data lines up with it, because the other data didn't show anything offsetting housing. So I think there are questions at times around the data quality. But I think to your second point, can they spin their way out of it? Absolutely. I mean, the Chinese government at the central level has very low debt levels. The problem is their local and provincial governments have a tremendous amount of debt and historically depended on real estate developers for 40% of their revenue. That's gone down to 20% because they're not selling much land because people don't want to develop when you've got a housing glut. So there's room to move. But really oddly, one last comment, Xi Jinping has been very opposed to what he calls welfareism, and the central government does not want to incentivize consumption. I think what they've counted on for years is that they could export their way out of it. But with the U.S. trade war, you can't sell it to the U.S., and now Europe is finally saying, wait a minute, you're dumping your electric vehicles here. So Europe put 40% tariffs on a lot of EVs from China. Brazil's imposing tariffs. Mexico's imposing tariffs. I mean, so it's getting harder for China to kind of work its way out of this without that domestic spending.
How about the reproduction rate?
Oh, sorry. Yeah, sorry. Well, the reproduction rate, I would just say, I think you're absolutely right. The problem in the U.S., I mean, if you really look at it, we have an aging society. It's not as bad as Europe, definitely not as bad as Japan. But absent, if you don't have migrants, I mean, if I could give advice to this administration or any subsequent administration, it would be that we absolutely need a comprehensive immigration reform program because we have agricultural companies that need workers. And by the way, I'm sure there are plenty of people who come here now illegally who would love a legal path to come in for 4 months, pick the crops, go back home safely and legally, and not be worried about getting arrested. And I think you got a lot of really smart people who could come in on the high-tech side and pay a lot of taxes. Bring them on. Let them pay down our deficit, and let's innovate. So I think we need to cross that spectrum, and it's not just ag and tech. It's a lot of industries. Yes, sir.
Thanks for being here. Outstanding presentation. Ben Graber of Southern Wealth. A little bit of nuance on the question that Barney was asking. So Chinese population, the one child left behind, they have a decreasing demographic of available workers. 3 out of the last 5 years, they have decreases in deflation instead of inflation compared to us. And so how much of it is a ticking time bomb for them, or hurry up and try to get ahead before they have not enough internal substance just to keep things going? You mentioned that they're an export-focused economy, but I thought it was the second or third slide you showed that you expected to have increases in either prices or productivity there. Thank you.
Yeah, so your point, I mean, by the way, the one-child policy, they gave that up. They eliminated the one-child policy, like 7 or 8 years ago. Then they went to a 2-child policy. Then they went to as many kids as you want policy. And honestly, the part that's interesting is birth rates did not go up at all. And what you've seen, though, is that people in China have the same issue people in the United States have. They're basically, young people are basically saying, okay, I need to have a house before I can have a kid. I need to have, and typically they want to own. The ownership rates in China are similar to the U.S. Actually, they're higher. I think they're 90% in China. But basically, they want to own a home. But then they're like, once I have a child, I have to pay for daycare, and I've got to pay for private education. And by the way, that's part of why 2-3 years ago, the Chinese government banned for-profit education companies because people were spending so much of their money on tutors. Because if your kid didn't get into the right school, they're out of luck. I was trying to think of a polite way to say that. Basically, so much of your life trajectory is, did you get into Tsinghua University? Did you get into this university? And people were miserable. They couldn't handle it. So I think they have a real issue. And the big issue to me, where China is very different from Japan, is when Japan ran into all these problems with demographics and debt, they were rich. China's not rich. I mean, the country is big, the $18 trillion of GDP. We're $30 trillion, but they have 4 times as many people, 4 1/3. So your GDP per capita is way below ours. And by the way, there are 180 million people in China who get a monthly pension payment of $30. That's their retirement. So again, this theoretically socialist country has a lot of people, they save so much, they don't buy as many goods because they're so worried about outliving their savings. And historically, grandma and grandpa or mom and dad paid for your down payment on a house. There are a lot of pieces of this flywheel. They're challenged right now. So I think China is in a bit of a race against time. And that's why it's frustrating to me and many other investors that they haven't figured out that they need to do structural reforms to kind of get back on the growth track. But there's this resistance. And by the way, one last thing, when you watch markets, the markets have transitioned now. When you get bad economic news, Chinese equity market goes up. Because I think a lot of investors are saying if the economy gets bad enough, they'll finally do what they need to do. But we've been thinking that for 3 years and it hasn't happened. Yes, sir. Any last question, I think?
Yes.
Yeah, thank you.
Yeah, excellent job. Thank you very much for being with us today. 2 questions. One, there's a lot of talk that's going on of Brexit, whether they will begin to come back together. How will that affect the European environment and affect the relationship with the United States? Secondly, Russia is really an economy with a gas tank. As that goes down, that cost of that goes down, the value of that goes down, and the expenditures on the war and loss of people, Isn't there a ticking time bomb there that they could in fact just implode significantly?
Yeah, so on Brexit in the UK and kind of reassociating with Europe, I think it would be political suicide for the administration, Starmer's team, the prime minister, to basically propose unwinding Brexit. But what they're doing kind of quietly is unwinding different pieces of Brexit. Basically, Europe and the UK are collaborating very closely on defense spending now. UK just won they just won their biggest naval contract ever from Norway. And I think they're actually in bidding now with the Swedish as well and maybe Finland. So they're getting a lot more business and trying to coordinate on the military front. Some of the damage of Brexit is hard to undo, and I think it was a self-inflicted wound by the UK, by the way. I mean, you've got basically I have to go back to my first slide. I think the UK economy is just shy of $3 trillion of GDP. The Eurozone's 5 times bigger. Who's got the leverage? It's the European Union. The Eurozone's got all the leverage. European Union, by the way, is even bigger. What I just quoted of 5 times bigger is just the Eurozone. So I think for the UK, they're in a tough spot. As it relates to Russia, if you wanted to be kind of snarky, you could say it's a gas station with nuclear weapons. But what's scary to me is they've got thousands of nuclear weapons. And, well, most importantly, their standard operating procedure is nuclear weapons are a tool of war that can be used. In the U.S., we've never adopted a no first use doctrine. We've always avoided that because we didn't want people to think we're not willing to use them. This has kind of been a case of strategic ambiguity. We want you to know that we can use them, but we're not going to say we're not going to, but we might. With Russia, it's part of the operating manual. And so, I think there are real economic challenges in Russia. The number of casualties in this war so far is over 1 million people. I mean, it's been horrible. And the challenge, though, is when you think about replacing Vladimir Putin, a lot of people in the United States, including me, would like for him to be gone. You can leave where he goes out. But the problem is if he's gone, you might get something worse. And so, I think with Russia, it's a real challenge. And one of the things that worries us the most is this kind of alliance you've seen form between Russia, China, North Korea, and Iran. And initially, it seemed like a marriage of convenience. It seems like it's a little more than that at this point. So, I'd love to be able to discount Russia more, but they're a really dangerous foe. And I think for the U.S., from a national security perspective, the other fear is Russia's got thousands of nuclear weapons, and China's trying to ramp up to have as many. Do we have to ramp up to have as many as the two of them combined? And if you start that, you're back to the early 1980s where we were spending tremendous amounts on nuclear weapons when you could already blow up the entire planet multiple times. But how do you get to a mutual kind of security arrangement? So what a fun way to end the meeting. But thank you so much for the opportunity to be here. Really appreciate it.
You've been listening to Ronald Temple, Chief Market Strategist for Lazard's financial advisory and asset management businesses, speaking before the Economic Club of Florida on September 15th, 2025 in Tallahassee, Florida. For more information on Lazard, visit lazard.com. The Economic Club of Florida promotes interest and enlightenment on important economic, political, and social issues of the day. To learn more, including how to become a member, visit our website at economic-club.com. This program was recorded at the Florida State University Alumni Center in Tallahassee, Florida.